There's been a lot of volatility recently in Chinese shares. The authorities have been very active in some tech stocks and some Chinese companies that seem to be on a trajectory to be bigger in some cases than some existing US behemoths, be it Amazon, Uber, or PayPal, have now shrunk because of regulation at home. What's happening and what's the outlook for Chinese shares? Welcome to this edition of Trading the Markets podcast. I'm Jeremy Naylor. Joining us now on the pod today are two analysts from KraneShares, Dr Xiaolin Chen, Head of International, and Brendan Ahern, Chief Investment Officer at the business. Welcome to you both. Dr Xiaolin Chen, I'd like to turn to you first of all. What is China's agenda here, do you think?
Jeremy, that's a very, very good question. We get asked very often by our investors to understand what is the intention. I think along the same lines of what is the intention of the Chinese government trying to achieve in the recent massive announcements in regulations impacting the sectors. I think at the end of the day, China is trying to achieve a very simple goal of a sustainable growth of the country. So they are targeting some of the areas, industries, and even at company level that, if anything, are potentially present risks or damage to the systems of the country to achieve their goal of common prosperities, and also the country to deliver a high quality of a growth in the long term. They want to deal with that problems now. A lot of investors reach out to us and asking, why now? Why so many? And at this time, if I could take a step back to think of the timing, I would think, post-pandemic, China probably at a time right now, or a window of opportunities that are less pressured to deliver a high growth in numbers, but they can focus on tackle some of the problem they think may present a problem or structural problem for achieving the goals we discussed at the earlier points. So that's why I think they are targeting on some of the regulations that impact the company levels, but also take this as an opportunity to say, you know what, we're less pressured. We don't want to focus on the high speed of the growth in GDP, but we want to deal with some of the problems. That being said, the announcements in regulations, in some of the changing direction in policies, Jeremy, in our opinion, nothing is come new in terms of the newly invented any regulations like antitrust, data securities. In the other way around, actually, they are trying to meet with the international standard. So the company actually get now impacted would actually have a long-term benefit of growing, more sustainable. So that's basically, where we see and how we see things is playing out now.
Brendan Ahern, as Chief Investment Officer, I'd like to ask you, is there any evidence that what the Chinese authorities have been doing is showing any benefit? Xiaolin was just saying that this is a long-term plan. I understand that. But is there any evidence so far that what they're doing is beginning to bear fruit? If so, again, from an investment point of view, how do we go about measuring that benefit?
Yeah, it's a great question, Jeremy, because I think, some element of the regulation we're seeing, it is multifaceted. And so I think the important thing that investors should realize is that thus far, the companies have really navigated, they've adopted and adhered to the regulation. We see that in the fintech space where going back to Q4, they've had to hold 30% of loans that they help originate. They can't lend to college students. They can't lend more than 200,000 RMB to any individual. We're seeing on the antitrust, the anti-competitive practices, the quote unquote walled gardens or proverbial moats these companies have tried to build around their businesses. Those are all going away. And the companies, from the Q4 earnings we got in March and February were good. The Q1 back in May were good. And more recently, the Q2 earnings financial results we got in August were quite strong. Now the one asterisk there would be two areas where the regulation clearly has hurt companies. And I would say, that would be the banning of for-profit after-school tutoring. And the second would be likely what will happen to Didi, that Didi went ahead with an IPO in advance of being regulated. And I think that was potentially a problematic. It's kind of an undiplomatic way to say that they probably should not have gone public in advance of the regulation, but they did so regardless, and they'll probably pay a pretty severe consequence for that.
So are you saying that China made a mistake in allowing the likes of high-profile company Alibaba, for example, listing in the US at all?
Well, I think the question would be, why have these companies gone public? And I don't think it's a mistake that they've allowed those companies, simply the U.S. capital markets are very deep, very liquid, very global in nature. And so, if you're trying to extract value via an initial public offering, the United States very much so is the best place to go public. Just because of the depth of the market, the global nature of it. So I don't think the companies going public is problematic in the United States. I think the issue with Didi was more of why they stopped Ant Group. That Ant went public, tried to go public before its IPO, and therefore its IPO prospectus was filled with financial data that was before regulation. And they could basically say to the company, well, your financials are going to change once you're regulated. That if you have to hold 30% of the loans you help originate, that's going to compress your margins, and that affects net income and earnings per share. So they could stop Didi because it was going to list in Hong Kong. In the case of Didi with a New York listing, they weren't able to stop it. And having met with Didi about a year and a half ago, I was very impressed with all the people I met. They're very smart. And I think down the road, we'll find out that potentially SoftBank, which has been raising cash, had made a significant investment in Didi, forced the IPO on them. I think in China, people knew that this regulation potentially was coming. And the folks at Didi are super smart. And I think ultimately, when you have a significant shareholder, they can potentially force the company to go public. That's conjecture on my part, but I think over time that truth will come out.
Xiaolin, we mustn't lose sight of the fact that we've got two sorts of companies here, haven't we? We've got the onshore and the offshore. Have the valuations of each of those two parts of the company been affected similarly? I mean, we've heard a lot, and indeed we can see it's quite obvious if you just look up the BABA ticker in the US exchange, you can see how much value has been, what we would say has been destroyed, I think, from what China has done. How has the valuation of the company at home changed, or what's going on? Because all we see, as I say, is a window on the Western listing of that particular stock and others like it.
We literally have two strategies at KraneShares. It all uses funds listed in locally here on, let's see, for our local investors. One fund is KWEB, and one fund is K-Star. The reason I mentioned these two funds was, Jeremy, one, the KWEB is exactly the basket of the names that are composed of Alibaba and all those big leaders, or in many sense, in the stage compared to their peers or some of the new rising stars domestically in China. And that fund, we have seen the valuation of KWEB has never been this low of this despite the strong earnings that Brendan has mentioned. The investors or the fund has been, really trading at historical low of discount level to that. And then on contrary is the other strategy called KSTR, K-Star. This fund is the names that you would think is the younger version of the KWEB. So if KWEB has Alibaba, Tencent, Baidu, all these big brothers that are already in the leader stages of e-commerce, musical, financial, or fintech categories, these names in K-Stars are the startup and also the rising stars of the companies. You can almost think of these names are Alibaba about 8-9 years ago when they considering listings. Obviously, given the nature of they are the startup, they are the new IPOs, their valuations are at the high level. But that is not relevant. What is relevant is, Jeremy, your your very first question on this impact on regulations on the companies, investors looking at the headline news. So when we investor will see, okay, what are the favor of the companies or corporates can continue to perform well and supported by the regulations and policies will be the names in the K-Star fund. These are all local listed on the Star Board. The Star Board, by the way, is under the Shanghai Stock Exchange. So it's mainland listed new startup companies in the semiconductors, in the technology sectors, and the new innovative green technology sectors. These names will benefit from a lot of government's policies. For instance, some of the semiconductor companies are exempt for corporate tax for 10 years. Governments is provide fundings for these companies to do science breakthrough technologies, with a very simple goal of when the Star Board was initially established after Xi Jinping's speech, a few years ago, was China to deal with the uncertainties, particularly the world's uncertainties around technology, to become self-sufficient. So these, you can imagine, these are the sectors in the technology, in all these sectors we mentioned, to become the industry leaders and world leaders in those instances. Their valuations clearly is high given the nature of the history of the underlying companies, but these are definitely a complementary, allocations and considering investment opportunities to the offshore listed companies, I have to say.
Brendan, let's bring you back in and talk a little bit about that in the context of what Xiaolin was talking about, the funds themselves, because both funds are available on the IG platform, and you've only got to call them up to see as it's laid out in all its nakedness as to what's happened with this recently. What is the timeline do you think China's working to here? When will this wave of new regulation end? And will that bring about a recovery in these funds? What are you waiting for? What do you think is catalyst going to be here to see these funds begin to tick up?
Yeah. And I think Xiaolin brings up a great point, Jeremy, is, funds like KBA and K-Star, provide access into China's A-share market, the Shanghai and Shenzhen market. And that market is predominantly owned by investors in China. And those investors have a positive view of China's economy, that post quarantine, the global economy reopening should be good for China. And that's been reflected, and those markets have held up fairly well. And I think we can contrast that with foreign investors' sentiment around China, which is really reflected in US and Hong Kong listed stocks, where, every day I wake up and I'll open the Financial Times and the Wall Street Journal, and, you get bombarded with some negative articles on China. And so, you have a very, very wide disparity of what Chinese investors think of China versus what foreign investors think of China. And I think part of the foreign investor sentiment has been the uncertainty around this regulation, that ad hoc implementation. The regulation itself is not necessarily a bad thing. You could argue elements look like the GDPR in Europe back in 2018, but just the uncertainty, just the way the news came out around the regulation, the lack of transparency, the lack of a timeline. And I think that element has been recognized in China, that you're seeing some proverbial green shoots on more transparency. So the data security law actually went into effect September 1st. The personal information protection law goes into effect November 1st, which means that's an end game. That's a finish line. And that's what the market's been starved for, is, knowing when is this going to end. We've also had some positive comments. Vice Premier Liu He gave a speech on the weekend of September the 6th, where he emphasized the importance of China's digital economy and private economy, which contribute to 50% of tax revenue, more than 60% of GDP, 80% of urban employment. So we've seen some statements to try to provide more transparency, that it's really been the uncertainty. And again, we've mentioned that the fundamentals of the companies, minus after-school tutoring and potentially what will happen with Didi, the companies have navigated. They've adhered and adopted to the regulation. The other thing we point out, Jeremy, is the companies themselves think the stock's cheap. Tencent's been buying back about 200,000 shares every day for the last 2 weeks. Baidu announced that in their Q2 earnings call that they've bought back $3 billion worth of stock since April 1st, and that Alibaba increased their buyback program from 10 billion US to 15 billion. And a smaller company called Joy, ticker is YY, announced that they're buying back $200 million worth of stock. And that's driven by the reality that the company has more cash than the market cap of the company. And we also had a company called Kuwashu Technology added to Southbound Stock Connect. And Southbound Stock Connect allows Chinese mutual funds to buy Kuwashu stock in Hong Kong. So why would they allow mutual funds to go into Kuwashu if they were going to hurt the company? So again, we're getting these proverbial green shoots, and we think as investors gain more confidence, they can come back into the names. That I think a lot of investors have moved to the sidelines, waiting for a proverbial green light to come back into these names. And we could argue that we're at kind of a yellow light moment right now.
The other thing, Brendan, of course, I know as a chief investment officer, you'll have your one eye, or part of one eye at least, on the economic performance of China. And as we speak, I know this podcast will be going out in a few days' time, but as we speak, we have just seen the release of another set of weakish data coming through from China. Retail sales, look, they're still growing. I understand that, but they're just not as strong as many economists had been expecting. Can I just quickly get your thoughts on where the overall economy is going in China? Are you concerned that there is an evidence of a slowdown, or do you think this is just a minor drawback in what is otherwise an economy that continues to grow?
Yeah, Jimmy, I think this is where China is so important for all investors, because you can make the argument they're about a year ahead of Europe and the US in terms of their reopening. And so the economic data we're seeing, the retail sales, industrial production, it's a year over year comparison. So if we think about that, China Q1 2020 has the quarantine, the economy falls, and then starting in the second quarter of last year, they're coming out of the quarantine. Economic data is rising, really tremendously. So now, a year, call it a year and almost a year and a half removed from that quarantine, these year over year comparisons, the bar gets harder and harder to compare. So yes, retail sales only went up 2.5%, but that's compared to last year where they absolutely came back in a really, really strong fashion. So the percent moves are going to diminish. And I think where a lot of economists believe that you'll see potential loosening in China, that China did not engage in this zero interest rate like we've seen from the ECB and the US Federal Reserve. They've not cut interest rates. So they have a significant amount of dry powder in order to put into effect as we go into the end of the year. And I think you'll apt to see a little bit of a loosening monetary standards in China in order to help with these percentage year over year comparisons. It's an important nuance, but it's something that will happen in Europe. It'll happen in the US, that the year over year comparisons are going to get really, really hard. And we're seeing that in China today, which was first in, first out.
Xiaolin, just want to return to you if I can and bring the interview to a close with one final question about what's been happening. Is what has recently happened in China new, or is there a pattern evolving here from prior behavior from authorities, the regulation, and the way that they're talking now to corporates and how they want to structure things? Is there a long-term plan here, or is this just something new that they've stepped in with as a new idea to try and rein in some of what might be perceived as an excess in Western markets?
If you ask me to look what they have implemented thus far and looking for alignments or indications of where we could see this would be the end of the goal for them to achieve, is their 5-year plan. In their 5-year plan, they have clearly stated green is something they are after, which they have provided some clarities, a lot of clarities on climate front. They set up the carbon trading, market in China. It's become the second largest in the world. And the technology, it does, the investor does feel the short-term pain, but they really will get the long-term gain down the road. I'm not just being optimistic because we have our solutions along it. The digital economy contribute almost 40% of China's GDP. So China has absolutely no intention to hurt that part of the economy or the sectors or industries under those sectors. That's one side. They want a high quality growth so that they are tackling all these problems to deal with some of the problems and give them a opportunity to rethink how they would structure them for the corporate to become long-term more sustainable. And then the other part in the 5-year for clean and also the long-term, the digital side of the economy and the technology is where they aim to. And obviously along the way, if one country will hear what investors say in the market and put that into an action, I would believe it's China. You remember market was worried about the real estate, the announced policies, regulations, and restrictions to deal with real estate market. Investors were saying China become aging. They hear you, they take their pace, and they dealt with the problem with the one-child policy removed, and then now the encouraging of more children in the family. This reminded me, Jeremy, I think the history of ours may share is in 1990s, probably about 10, 15 years post the open policy that announced by Dr Xiaolin, they did a huge reform for the state-owned enterprise in China. They let go of hundreds of thousands, if not millions of people retired earlier or find a second, career. And they literally privatized the state-owned industry in some instance and let private players come in. That is when China actually take off and then become really important in the economics fronts to deliver really good growth since and post then. So I think China will never short of a big ambitious goals to achieve and deliver. Can they deliver? If you look at the history, if it serve as any guidance, I think they would be able to deliver. Obviously, I'd agree 100% with Brendan is communication, transparency is what investors are welcomed. I don't think investors is against of these reforms and regulations announced, is surprised by how they communicated, how they get to learn about this. If those can be improved, market would welcome what would come as more of market-oriented reforms happening in China today.
And just to confirm, that 5-year plan you're talking about was the 5-year plan announced in August this year, or are you talking about the 5-year plan that was recently completed?
It's actually 2020 to 2025.
Right.
They literally had in March in 2020, they have a 5-year plan. We have covered this in quite a details in some of our product page. Do feel free to reach out to us. We'd be happy to share with you on that report in details. So every 5 year, the government will set a 5-year plan for the next 5 year to achieve. Typically at the beginning of the 5 year, they would set very clear the directions for the economy to go. It's almost like you and I have a New Year resolution of what we're trying to achieve. This is what the government agenda, and they will review every there and in between. In our opinion, this is the beginning of the 5 year. Obviously, this is the second year into it. They want to set everything right to the direction and to the way they desire to. Then following would be the implementation to see the results or any adjustments. At the end of the day, they do want this to become successful and deliver their agenda.
Look, it's a pleasure talking to you both. Thank you so much indeed for your time explaining more about the volatility that we're seeing in China at the moment. Thank you so much for your time. That's Dr. Xiaolin Chen, Head of International, and Brendan Ahern, Chief Investment Officer at KraneShares. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.